Here with me today are Mr. Narayan Gangadhar, Chief Executive Officer, Mr. Vineet Agrawal, Chief Financial Officer, Mr. Hetul Gutka, IR Head, and SGA, our Investor Relations Advisors. I trust all of you and your loved ones are safe and in good health. We have published a detailed investor presentation and issued a press release to stock exchanges, and I hope you had a chance to peruse them. I will comment on recent development, and then Narayan and Vineet will walk you through the operational and financial performance for the quarter. Q1 FY22 was marked by a resurgence of COVID cases. This wave of COVID-19 peaked in April 2021 before plateauing in May 2021 and declining in June 2021, that is last month. Because of the widespread effect of pandemic on businesses throughout India, multiple agencies revised their GDP estimate. However, with accelerated vaccination drives across the nation, economic activity has resumed. The Indian economy is resilient, and with strong fundamentals in place, we are prepared to bounce back. In the midst of all this gloom, Q1 FY2022 has been very strong for the broking industry, with quarterly performance continuing to achieve significant milestones. India's investor base continued to rise, with over 7 million new Demat accounts being added during this period. This number represents approximately 50% of new Demat accounts added for the whole of the last year. This strong addition in Demat accounts reflects the growing popularity and deepening penetration of equities in Tier 2 and 3 cities and beyond. While total Demat accounts reached 62 million on June 30, 2021, equity penetration in India continues to offer huge growth opportunities, and our expectations are it will match or in some cases exceed those of peer economies in South Asia and mature economies in the West progressively. The narrowing gap between us and them gives me immense confidence that we will be able to sustain this journey of high growth over the medium and long term. This potential will be tapped largely by digital brokers, including angel broking, as we accelerate penetration further into Tier 2, Tier 3 cities and beyond, using best-in-class digital products to give customers a state-of-the-art digital experience, thus expanding our share of overall market pie. This strong growth in Demat accounts has translated into corresponding growth in an active customer base on NSE, which grew by 3.5 million in Q1 FY2022 to 22.4 million as of June 2021. Of this active incremental clients, approximately 77% were contributed by top 5 digital brokers, with angel broking amongst the leaders in this pack. As a result, the share of top 5 digital brokers in NSE active client base expanded by 467 basis points sequentially to 52% as of June 30, 2021. Angel has consistently improved its NSE active client base and now ranks third in India in terms of its client number. And I am happy to inform you that Angel is now the largest listed broking house in the country. A significant part of this growth is attributed to our transformation into digital first and fintech business model, which has enabled us to redefine our processes by extensively using artificial intelligence and machine learning to enhance the digital experience of our clients. To entrench our strong connection with our clients and effectively communicate our product and service offering to our target audience, we have redefined ourselves from angel broking to Angel One. As angel broking, we were perceived as a single product traditional broking house. However, we needed to break this perception and create a better connection with the youth, Gen Z, millennials, and effectively communicate to them our bouquet of digital financial products and services, ranging from protection and wealth creation products to passive investment options through our AMC business, all of which will be offered under the umbrella brand of Angel One. Over the next few quarters, we also plan to launch our super app, which will facilitate client access to all these products. Coupled with this, our focus will be on further improving the digital journey to give our clients a superior experience. This will lay the foundation for the next phase of our growth as we aim to attain market leadership in retail stockbroking over the next few years. During this journey, we will be taking on board experts with exceptional digital prowess. This may lead to an increase in employee benefit expenses for 2 or 3 quarters, but will greatly complement the business by building an unprecedented team of experts with augmented artificial intelligence, machine learning capabilities, which will spearhead our growth initiatives. By taking these initiatives, we aim to make investing and wealth creation extremely easy, thereby deepening the penetration of investing across India. In FY 2021, we adopted a formal and more inclusive dividend policy to take care of the interest of shareholders. In this context, I am happy to share with you that for Q1 FY 2022, the board has recommended the distribution of 35% of this quarter's profit as a first interim dividend to the shareholders. I will now ask Narayan to give you a brief on operational aspect of the quarter. Narayan.
Thank you, Dinesh. Good morning, everybody, and thank you for joining us on the call today. As Dinesh mentioned, the industry witnessed strong growth even on a larger base during the quarter. I would like to emphasize here that Angel has played a key role in this growth. Q1 FY 2022 has been a very strong quarter for us across a whole bunch of parameters. We continued with our robust post-client addition as we added 1.2 million clients in Q1 FY 2022, the highest we have achieved in any quarter till date. Of this, 0.46 million clients were added in June 2021. Again, our best monthly performance in terms of gross client addition. Our digital assets continued to attract more Gen Z and millennials from tier 2, 3 and beyond cities, which contributed to more than 93% of our gross client addition during the quarter. With younger clients being onboarded, the median age of our clients has dropped further to 29 years. Simple to use digital properties coupled with best-in-class digital journeys and simplified pricing led to 93% of gross client additions coming under our flat fee plan during the quarter. This overwhelming performance in client addition led to over 28% sequential growth in our client base to 5.3 million in June 2021, and thus creating another huge milestone for us. Correspondingly, our NSE active client base also grew by 26.5% sequentially to our historical best of approximately 2 million as of June 2021. This represents that over 37% of our overall active client base was active on NSE as of June 2021. As we added more active clients on NSE, our market clients points to sequentially to 8.8% as of June 21. This healthy growth across overall and active client base also translated into 21.1% sequential growth in our average daily turnover to 4.5 trillion rupees and approximately 14% sequential growth in the number of trades to 248.5 million in Q1 FY 2022. During the quarter, we handled about 5.4 million peak trades in a single trading session, thus highlighting our robust IT infrastructure. In June 2021, our turnover and turnover market share were partially impacted due to the implementation of phase 3 of peak margin regulations, apart from other market factors, when compared to April and May 2021. We expect this situation to normalize going forward. Despite this, our net broking revenue for the month of June was higher than the average for the quarter. and we achieve our best overall retail equity ADTO market share of 22.7% in Q1 FY22. On the innovation front, in June 2021, we launched Smart Store, an ecosystem that will serve as a marketplace for fintech-based products and services, including rule-based investing solutions and investor education services. Smart Store will also give traders a social forum to interact with each other. This platform will provide our clients with access to a variety of verified fintech products and solutions at an affordable price that can potentially help them trade effectively. Our fintech partners get access to a marketplace where they can market their products to a large and growing client pool. Using our Smart API, our clients will be able to bundle these solutions and trade seamlessly on our platform. We're also working on our Super App, which is expected to be rolled out later this year. Finally, we are still very young in our journey, and there's going to be a lot of transformation that we will be undergoing in times to come. With the thought of providing best-in-class, seamless, and unique experience to our clients, we are continuously investing in upgrading our technology expertise based on augmented use of data science to improve ability, reliability, and availability of all our platforms. Over the next 10 to 12 years, we foresee massive growth opportunity unfolding in the fintech industry. As Bharat opens up more aggressively to the idea of systematic wealth creation. Today, all of us are just at the inflection point of this fintech revolution. After being about a quarter old into the system, I'm sure that Angel has the skill set and the capability to attract the relevant talent to fill in the gaps, progress towards our aim of attaining a leadership position over the next couple of years. With this, I now request Mr. Vineet Agarwal, our CFO, to give you a brief on the financial performance of the company. Thank you. Over to you, Vineet.
Thank you, Narayan. Good morning, everyone, and I once again thank you for joining us today. I will take you through the financial snapshot for the quarter gone by. As explained by Dinesh Bhai and Narayan, Angel continued to deliver an exceptionally strong performance on all operating parameters, which also translated into strong financial results for the quarter. In quarter one of financial year 2022, performance mirrors our strong momentum in business as we registered our highest ever gross revenue of rupees 4,745 million. Some of the key drivers of our performance were strong client addition of 1.2 million, robust 21% sequential growth in our average daily turnover to rupees 4.5 trillion, with trades aggregating to over 245.5 million. A fledgling client book which clocked a sequential growth of 26.5% to average at 12.2 billion. Quarter one of financial year 2022 revenue is bifurcated as follows. Gross broking revenue accounted for about 68% of our total gross revenues. Interest income, which includes interest on our client funding book and interest earned from deposits, accounted for 15%. Depository income contributed 6%. Income from distribution of third-party products was 1%, whilst other operating income contributed 10%. In gross broking revenue, the contribution of our F&O segment increased to approximately 63%, followed by cash, commodity and currency at approximately 31%, 4% and 1% respectively. During the quarter, we witnessed strong participation in the options and cash delivery segment, with the latter leading to a growth in our average client funding book to approximately 12.2 billion. After paying commission to our authorized persons, approximately 74% of the net broking revenue was contributed by our direct clients, whilst the balance is attributed to the clients of our authorized persons. Since we have been adding clients at a very brisk pace over the last 2 years, the net broking revenue from clients who are less than 2 years on our platform continues to remain high at 74% in quarter one, whilst the balance is contributed by more than 2-year-old clients. Contribution of our net broking revenue by less than 2-year-old clients and 2+-year-old clients grew by 3x and 3.7x and 2.4x in quarter one of financial year 2022 over Q1 of financial year 2020, respectively. Our net broking revenue under the flat fee plan continued to witness strong momentum, having grown to a significant 76% of our overall net broking revenue. At the same time, the share of net broking revenue from the traditional plan in the total net revenue pie has been reducing consistently from 50% to 15% over Q1 of financial year 2020 to Q1 of financial year 2022. The finance cost increased to 164 million during the quarter, primarily on account of incremental borrowings to meet the working capital requirements. Employee benefit expenses increased by approximately 12% sequentially to rupees 561 million in Q1 of financial year 2022, mainly on account of annual revisions in payroll. Our other expenses rose to 1.12 billion, with a 11.3% rise quarter-on-quarter on account of higher client acquisition, onboarding, and engagement. The operating profit for Q1 stood at 1,663 million, translating to a 49% operating profit margin. Our profit after tax from continuing operations increased 19% sequentially to rupees 1,214 million, once again the highest ever for any quarter to date. Earnings per share grew to a robust 14.8 rupees per equity share on quarterly basis. Our quarter-ending client funding book was at 15.2 billion, whereas our borrowing stood at 12.2 billion. All the above translated to a very healthy average return on equity from the business at 41.6%. With this, I conclude the presentation and open the floor for further discussion. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, you may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ankush Agarwal from UTI Research. Please go ahead.
Yeah, hi. Thank you for taking my question. So firstly, in our old business model, whenever we had a market correction, the overall market value used to go down. And since we had a take rate as a percentage of market value.
Your voice is a bit low.
Is it audible now? Hello? Hello?
Continue, please.
There is some background noise.
Is it better at the moment?
Yeah, it is better.
Yeah, sorry for that. So firstly, in our old business model, since our take rate was based on a percentage of our value, and whenever there was a market correction, ideally our broking revenue used to go down, right? But now with the business model has changed, wherein it's a flat fee based business model, wherein it depends on the volumes, right? So do you think it makes our business more resilient in terms of a market correction, since volumes might not correct that much compared to a market value based model?
Yeah, Mr. Agarwal, you are right. See, what happens like when market goes down, as rightly pointed out by you, client tend to trade less. But now because model is as per order, so what happens, even if a ticket size is low, our revenue does not drop equivalent to a drop in turnover.
Right.
It is more resilient, and plus we being on app now, we have seen that even lifetime value of customer has improved. So people who used to trade less after a year or so, after completing this 4 quarters, what we are seeing, trend is improving from older customers also because they are on the app.
Right. So, do you have any data point to share, in terms of last couple of years, whenever there was a market correction, did volumes help you be resilient? Like, for example, last year in March, when the market corrected 30%. Did you saw that time the volumes helped you sustain some kind of broking revenue? If you have some data point, if you can share.
I don't think we have any data point on that to share right now. Vinit, there is anything on you can comment on this?
No, right now we don't have any data point, but yes, the mobile app model, the digital model definitely helps, the stickiness of the client, as well as the fact that clients trade less in terms of the volume, but in terms of the number of orders, the behavior is continuing.
For example, Mr. Agarwal, if you see this peak margin kind of like when it was implemented, there's an impact on turnover, but we don't see much impact on our revenue, proportionate to impact that we are seeing on turnover.
Right. Got it. Just secondly, I want to understand if you're facing any hindrance in terms of getting market share in the F&O volumes, because as per the regulations, for example, in case of index, there's a 15% limit that a broker can go, right, in terms of open interest, and in terms of individual securities, I think it's 20%.
Yeah.
Right. So do you think it will impact your volumes at a later stage? Not now, but do you see that impacting our ability to grow your market share?
See, Mr. Agarwal, still we are far away from that limit, and so that way we are not would not be impacted in near future.
Okay. So got it. So in the retail side, we had currently you're sharing the Q1, we had 22% kind of market share in the F&O retail turnover, right?
Yeah, right.
So can you share? Do you know what is the split between the retail turnover versus institutional turnover in the? Hello.
Ankush, we would request you to please come back in the question queue for any follow-up questions. The next question is from the line of Nidhesh Jain from Investec. Please go ahead.
Thank you, sir. Firstly, sir, if I look at the MTF book, it has grown 26% sequentially, but our interest income has not grown proportion to that. Interest income growth is around 15% sequentially. So what is the reason for that?
The interest income comprises of both the interest we earn from the client funding book as well as the interest we earn from fixed deposits that we place with the exchanges as margins. So whilst the client funding book, the interest that we charge on the client funding book remains same, but there has been a decline in the interest that we earn from the fixed deposits. So the client funding book continues to remain strong with the same rate of interest. The rate of interest that we charge to our clients is about 18% for the MTF funding.
Okay. So it is largely because of the decline in the interest on fixed deposit that we keep with the exchanges.
Yes.
And secondly, we are transforming ourselves from a pure broker to a more holistic financial services player. So we have articulated that we will be launching our asset management platform, which will take probably 2 years from now to complete the process. So apart from these two products, which is asset management product and the broking product, what all other products we expect to add in our super app that we are planning to launch over the next 2 to 3 quarters? Hello?
I think there is some problem on the line. Can you just hold on for a few seconds, please?
Yeah.
Mr. Thakkar, you can go ahead, please.
Yeah.
So should I repeat my question?
Yeah, I was unable to hear you because I got disconnected.
Yeah, sure. So I was saying that we are transforming from a pure brokerage player to a holistic, more comprehensive financial services player. We have already articulated that we will be launching our asset management product, which will take probably around 2 years' time from now. But there are a whole set of other financial service products which fintech companies are planning to offer, like lending, like insurance, like other segments. So what all other segments we plan to add into our super app that we are planning to launch?
Yeah. So currently we are offering all other services like third-party product, mutual fund, insurance, and lending product, third-party product. We are not manufacturers in that. So in the super app, in this journey, investors who are coming for broking services, they would be able to select their mutual fund. They would be able to do their insurance kind of like business on our platform. Plus, we would be offering them lending product from other banks. So overall, the super app would be a kind of a one-stop solution for investors who start their journey in stock market, but eventually when they want to buy mutual fund or create some kind of like wealth through acquiring mutual fund or going for insurance product, this app would be helpful for them to manage total kind of like financial solution, their requirement of all financial products. Until we in 2 years we are able to start manufacturing our own product, which would be more passive and ETF products, which will help investor to take advantage of this equity as an asset class.
Sure. So, and any expectation on the revenue that we expect from the other products that we are adding? So today our distribution income is pretty small in overall revenue. Any expectation or guidance or target that you are setting up?
We are in that kind of process of launching our super app, which will take at least 2 quarters from here. So we are expecting once this super app is launched, we would see a good revenue coming from this third-party products. But for this 2 quarters, we don't see substantial change in our revenue mix. Maybe post in the last quarter, we can see some more kind of traction from third-party products.
And in the super app, the customer will also be able to trade. So there will be only one app.
Yeah, there will be only one app. That's the reason actually when we change our name from Angel Broking to Angel One, what we want to signify is that all your financial product would be available on one app. So on this app, they will be able to trade. That is what actually we want to achieve. That on the same app, when person is trading for stocks, how we can build a more journey so that we are able to understand customer better and offer them solution for their needs or for future. So what happens when we get into that kind of trajectory of customer looking for wealth creation on our app, a lifetime value of the same customer increases. So cost of acquisition remains same, but additional revenue that we get straight away it comes to our bottom line.
Yeah, understood. And last question, you mentioned that you will be focusing on digital hiring, and you also articulated that there will be increase in the employee cost. But any quantification on the employee expense that one should expect over FY21 base for FY22?
See, currently we are in the midst of hiring process, so it would be very difficult to give number in terms of how much increase it would be. But I can say one thing that, see, we are looking at kind of client growth which is growing at a triple-digit rate. So we would be able to manage this cost within these parameters what guidance we have given for our margins. So with this margin guidance of around 49 to 50%, we would be able to accommodate all this cost within these 2-3 quarters.
Sure. That's it from my side.
Thank you.
Thank you. The next question is from the line of Abhay Agarwal from Piper Serica Advisors. Please go ahead.
Good morning, Dinesh ji, Vineet, and rest of the team. I have a question related to this variable margin requirement that is going to further go up from 75% to 100% from September 1. So we have seen already that that has impacted the ADT in recent months, though the number of new customers has increased, but the ADT has remained the same. I guess that peak margin is creating pressure not only on Angel One, but also the rest of the industry players, including exchanges like MCX. So what is your expectation? What will happen to your ADT, once this goes up to 100% from September 1? Or do you think there is a possibility that SEBI may reconsider by then the peak margin requirement and keep it either at 75% or actually bring it down? So, if you can just share your thoughts on that.
Yeah, on peak margin requirement, as every quarter I say that there will be an impact on ADTO. But because our revenue is generated by a number of orders that the client places, so what we have seen, impact on revenue is not very substantial. It is just in the tune of 2 to 3%. And that is offsetted by growth in our customer base. So going forward, now we are coming to that last tranche of this implementation. I don't feel that SEBI is going to defer this, but because we work on what is announced. If something is announced which is better than that, we will see some positive thing. But what we are seeing is our revenue may get impacted by just 2 or 3% maximum. Every tranche we have seen, impact is to the revenue is 2 to 3%. But impact on turnover is higher. But because our is a flat fee base, so impact of 2-3 is offsetted by a growth in customer base, which is growing at the rate of almost like 15 to 20% every quarter. So we are not expecting any big hit from this last tranche of peak margin implementation.
Okay. No, thank you very much. That is very useful. Thank you, Dinesh.
Thank you.
Thank you. The next question is from the line of Prateek Poddar from Nippon India Mutual Fund. Please go ahead.
Yeah, hi. Just a couple of questions. One is, in your annual report, you talk about this project Spark, right? The new product offering, which is Spark. Can you just talk a bit about that? That's question number one. Secondly, as we have discussed in this call, that incrementally ADTO is not a driver for Angel anymore. Is market share or looking at ADTO market share of any relevance? And lastly, sir, I think you've talked extensively about in your annual report about WealthTech, right? Becoming a WealthTech platform. I just wanted to ask in terms of employees or, filling up gaps, where are these positions or what needs to be done so that at least from a foundation perspective, we are there?
Okay. Prateek, on your first question about Spark, Spark is like a first leg of Super App. So a Super App would be built on this platform, which we pet named it Spark, but that will replace Angel One once it is ready in 2 quarters. So this app would be having all journeys apart from stockbroking. It would be having journeys for mutual fund, insurance, lending product, all third-party products. And going forward, when we would be entering into AMC business, so this would be the app which would be like an interface for a customer to consume all our services. So we are expecting that by next 2 quarters, we'll be able to launch this app. And now coming on your second question on ADTO. ADTO definitely gets impacted, but as we have gone to flat broking plan, we look at number of orders and customers' engagement. So market share definitely is relevant because in digital players, there will be only few players who will be dominant in terms of generating revenue and being profitable. So our aim is to be number one, and within few years, we want to be there. The only way we are tracking is to increase our market share in acquisition and market turnover. Third thing on WealthTech, already we have taken lots of steps as last time I had discussed that ARC is an engine which is going to help us to generate a smart beta product. So already lots of investment has gone in creating lots of backend which can help us to give better returns and give up passive products which can engage lots of customers who are entering the market with a low ticket size. So even with ticket size of around 25,000-30,000, we can guide him with a good portfolio. But what happens once we are going in WealthTech, with AMC being an interface, we can reduce our ticket size to lower, which can help lots of tier 2, tier 3 people to consume these products. So in terms of WealthTech, I think we have taken lots of back-end innovation, and plus currently whatever recruitment we are doing, this recruitment is mostly on people who are good at machine learning, artificial intelligence, creating better journey for customers. So in this 2 or 3 quarters, you will see lots of cost on this front getting front-ended over here. But good thing is that because there is a good growth in broking business, we would not be suffering in terms of getting in this front-end cost, which is overbearing on our margins. So we will be able to retain this margin. Maybe 1 or 2 quarter we have to build these resources, but this same resource is going to help us to build a better journey for stockbroking. So that will give us more customer engaged on our platform, and we'll be able to generate more revenue from the same set of customers.
So just to conclude, sir, this means that your lifetime value of a customer increases because you are adding these third-party products, and also the engagement level or engagement matrices increases, right? That is what your eventual end plan is, that by the end of the year with the launch of Super App, the lifetime value of a customer increases multifold, plus the engagement levels which were earlier only limited to broking will now further increase.
Yeah, you are right. So purpose is that once we acquire a customer, cost of acquisition is upfront. We have already taken. So when we offer other products and they are able to consume this product, lifetime value increases, because when they consume this mutual fund, insurance, which is their lifetime goals, they are going to remain with us lifetime till the time they are enjoying our app. That's the reason we want to make this app very engaging, so that people who have come on the platform just for broking, they find this app more relevant even for their other needs, financial needs. So that is the reason we feel that total lifetime value of the customer will increase, and even experience the customer would have would be very easy and convenient to do all the transaction on one app.
So if I may ask just one small question on Smart Store, which you have launched, if you could just help us understand the revenue model over there, because I think it's a platform, right? You're onboarding fintechs on your platform, as well as the customers can access those technologies of those fintechs and trade via Angel. So it's a win-win for both. What kind of number of users who have signed up for Smart Store, and what kind of engagement levels are we seeing? Because that itself can become a data monetization property or a value creative digital property for you. So maybe some numbers over there would be really helpful, if at all.
It will be very early to give numbers right now, but I would ask Narayan to talk on this, because it's a very unique concept. Just let me give you a brief of this. See, India, if you see, there are lots of young engineers who are building lots of solutions for niche investors, algo traders and all that. So what we thought that, see, world is moving towards platform. World is moving towards where we are able to get lots of people who use our API, who use our technology skill set. And plus, very important thing is, when they create a solution, big cost goes into marketing that product. That is where our customer base of around 53 lakh come into play, where people who develop a good solution and clients are able to get a better solution for them, where we would be having a revenue sharing model. On technology side, I would ask Narayan to briefly talk on this.
Yeah, thank you, Dinesh. So as Dinesh mentioned, we are creating this unique platform on the Smart Store side to let people build and explore a wide range of trading applications on the platform. And what we have seen is when developers they sign up to this service, to this unique service, they get a set of features right out of the box for free. That includes the profiling of the customers, that includes the ability to trade on our platform, using APIs, and that includes the ability to get analytical data about how their apps are performing in real time. So this helps developers create a very unique set of experiences and launch them on a platform which can also then be leveraged by other users. So as Dinesh mentioned, we have more than as of this week, we have more than 100,000 unique users actually on this platform, and we are averaging a significant amount of a non-significant amount of revenue, which is already being, traded essentially on the platform. So the way I see it is this is only going to continue to grow to eventually becoming a mainstream product for us. But right now, we're very happy with the traction we are seeing early.
Which customer set would be most apt for that particular strategy? And is there a nudge being then given to the customer to, use that strategy, which is a win-win, right? Because the customer wins, the fintech company also wins, and your platform becomes more stronger. Is that what you're trying to do over here? I mean, is that a value proposition which you're doing?
Yes, let me come over here. See, today if you see trend is youth wants to do some kind of like data testing. They want to do some trading. That's a big kind of community which is getting created. And there are lots of engineers who are creating solutions for this youth. But only thing that we have to be a person, an organization who matches the both end. There are creators of this kind of solution and there are people, users who are big in number. But progressively, if you see now, when we talk about like financial services and all that, there are lots of solutions needed which will use our APIs. But this would be niche solutions for a niche market. But we would be creating a platform where customer can come, look at their requirement, check which app is relevant to them, and try and start using that on our platform. That way, even a person who is creating the solution gets an access to our resources plus our market, and customer gets a best of service.
Thank you. We would request the current participant to please come back in the question queue for any follow-up questions, as we have several participants waiting for their turn. The next question is from the line of Kajal from ICICI Securities. Please go ahead.
Hello. Hi. Good morning, sir. In the opening remarks, it was told that out of the total clients acquired, almost 93% came on the flat fee platform. So just wanted to understand, because earlier we were saying almost 20% of client acquisition happens through the AP model. So is that changing now and the direct model is working more? And how are the clients as of now acquired? Which modes are working faster?
Vineet, you have numbers on this? Just to briefly, I'll tell you that, see, when we say 93% are using flat fee, just for information, even we allow AP to offer this flat fee to that customer. So although our revenue will be coming from AP, but lots of plans which are sold by AP is flat fee.
So under the flat fee plan, during Q1 of financial year 2022, we acquired 11,25,000 clients, and under the traditional plan, we acquired about 80,000 clients.
Okay. So which modes are working more for it? Like in this 11,25,000, which modes of acquisition have worked better, and in terms of cost of acquisition, how they have been?
Digital acquisition engine definitely is optimized to a level where it is giving a good numbers. So most of these numbers are coming from direct B2C acquisition. And Vineet, you have number on breakup of this acquisition channels?
No, sir, we don't share that.
Okay. Just to give you a sense that most of this growth is coming from digitally acquiring, we are acquiring channel, and AP model definitely it is a physical model, so their growth is lesser.
Okay. And one more question on the technology cost. So last quarter, I think we had shared that almost 30% of the other expenses, which was around 47-48 crore, is the technology cost. So what would be that number around in this quarter?
Vineet?
Yeah, it will be the same. So as I mentioned, about 13 to 14% of our total cost, excluding the finance and commission that we share with the subbrokers, that proportion continues.
13 to 14 or 30 to 40?
No, 13 to 14. I had mentioned 13 to 14, not 30 to 40.
Okay. Okay, sir. Okay, thank you.
Thank you.
Thank you. The next question is from the line of Deepak J from Girik Capital. Please go ahead.
Yeah, hi. Congrats for good set of numbers. I have a question regarding ARPU. So ARPU has come down a bit compared to the last quarter. So can you point out the reasons for the decline? Are there any offers or series that you're offering which has led to such a decline? And I have another question on the activation rate. So this rate has been consistently high from the last 4-5 quarters. If the market if the market doesn't do as well as it is doing right now, can there be an impact on the activation rate going forward?
Okay, I don't know whether we give number on ARPU. It is derived number, I think so.
Yeah, so it's a derived number.
It is derived number. So because now new set of customers, as I said that in AP also we are acquiring customer on flat fee. So I'm not sure how it has been divided. Vinit, there is any data on that?
No, we do not share any ARPU related data.
Okay, let me come to second question on activation. See, activation again, like I am seeing it is a function of one volatility in the market. Second is people who are coming from tier 2, tier 3 now. Most of the customers are coming from that pocket. Over there, we are not seeing a major impact because of volatility currently. Because if you look at our last quarter number, as we said, even June, we did not see a significant drop in volume where volatility in the market had reduced substantially. So we are seeing because we are more exposed to tier 2, tier 3, where customers are new, that ticket size may be lower, but in terms of revenue, they are almost equivalent to our majority of the customers that we acquire. So overall, I don't feel that volatility would be having a major impact, although there is an impact. Always there would be an impact of volatility, but not to the tune where we see a significant drop.
Right. As you mentioned ticket size, do you have any number as to what is the average ticket size and average investment account of the customers and of the customer set right now?
Vinit, we have shared any ticket size number?
That we don't share. We don't share the ticket size of individual clients.
Okay, no problem. So just one more question on ARPU. So what I've done is I've just divided the broking revenue by the average number of active clients during this quarter and the last quarter. So earlier it was that number was 2,064 in March quarter, and now it has come down to 1,800 and 1,800 kind of a number. So essentially, whatever revenue I'm making on each client per quarter has come down a little. So I just wanted to understand, will this trend kind of continue? Is it the new base? Can we consider it a new base, or there's a possibility of further decline, or can it come back up going forward?
See, as I said that maybe in March we may not be adding much number on AP side on flat fee, but what we are seeing, the sources that we acquire, RPU is almost like consistent. There is a few fluctuation because of peak margin and volatility, but not to the tune which should be like concerning us. But when we add a new channel, we look at unit-wise economy. If that is working, we would like to be acquiring customer on that front also. Like as we introduced or we pushed our AP to offer flat fee to their customer, we do our working back end. It may appear that overall ARPU has reduced from that pool. I'm unable to specifically tell you on your question of 2,000 and 1,800, just I'm giving you an example. So when this new source of customer comes, which is AP driven, we don't have a cost of acquisition on that. But whatever fees they generate or revenue they generate, it is just shared with us. So in terms of unit-wise economy, it is far better. But it may impact the overall ARPU. It may appear to be lower from that source. That is what maximum I can share with you right now.
Right. If I can squeeze in one more question. So will there be any linearity between the growth rate of your active clients and the growth of revenue, especially the broking revenue? Or will the broking revenue growth will always be lower than your client addition growth rate?
See, you have to add some factor. Always you will see there is no correlation between growth in customer turnover and revenue. So you have to see few quarters, whatever factor was there, it would be growing with that factor. So overall, we don't see, as I said, dip in quality, but what happens many times, because of different kind of like customer coming from different source, so it may not be linear in terms of number of customers that we acquired and growth in revenue proportionately.
Thank you. We would request the current participant to please come back in the question queue for any follow-up questions. The next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Sir, thank you for taking my question. Just one question which was related to your flat fee pricing. So, because of this extremely high growth in client base that the industry is seeing in terms of the discount broking industry, do you see any chances of or any probability of increasing about lowering of the flat fee for the various products like intraday and FNO, etc.?
See, currently I don't see any kind of gain in market share because of lowering the fees. Because if you see, this fees is just small part of cost that a customer pays. So I think customer is looking at more engaging journeys built in an app. So what I see is that's the reason we are building our cost on technology side. Not only we are building it for super app, but what happens, this kind of talent which comes in, they improvise on journey related to stockbroking. So what I see is that organization who is able to build a good journeys, invest good on a technology team, they will be able to grow their client base, and this client base will continue only if you continue investing in this tech assets. But otherwise, reducing flat fees is not going to give incremental market share. Already one or two players have tried, you know it, I don't want to name them. They were unable to get any major market share. In fact, they reverted back to the same flat fee.
Understood, sir. And secondly, while we are building this super app, and maybe Narayan may be able to answer this question a little bit better, but I think globally we have also seen that, when you have too many things at the same place, generally those sort of super apps, I don't know if there are many global peers which have done a lot of success in that particular area. I think mostly, apps which are focused on a particular category have sort of done very well. And so, how are we planning to think about it? That if we offer too many things, would our positioning get diluted in terms of, how we are perceived by the customers, and when an incremental customer comes, what is his expectation? So how are we thinking about that, rather being a focused player compared to, trying to do everything at the same time and maybe diluting our positioning or experience in terms of the new customers?
Mr. Gupta, excellent question. I will ask Narayan to answer, but let me just briefly touch upon that. Okay, we have always been a focused player. Our aspirations are clear to be number one in broking industry. Because we know when any industry goes digital, there are big kinds of benefit being number one or number two. So we would not like to compromise on that position. Never we have done. Angel, if you see from beginning, we have been focused on retail broking and we want to be number one. But what we are seeing now, capabilities of apps are such that without diluting that experience, we can enhance the experience by building lots of other journeys. Here I would ask Narayan to step in.
Yeah. Thank you, Dinesh. So as Dinesh mentioned, right, broking and trading, they remain our core areas and core focus for our business. So our entire app strategy is built around making that experience very seamless for the end user. And, you are right that having more journeys, it tends to overload the application. But at the same time, having those journeys built in a way that is very responsive using machine learning and user filtering techniques really helps us build a best-in-class experience which is tailor-made for a particular client. So their overall experience and immersiveness with the application actually only gets better. That is really the experience that we are building and we are investing in on Angel. So our super app strategy is not like the other super app strategies where we envision building 3 or 4 different type of disconnected workflows or 3 or 4 different types of different app experiences in the same app. That's not how we see it. We see ourselves as building a single unified experience which is very intuitive, which is built on understanding the customer, and it is built on maximizing the return and the value that they get by spending time on the app. That is how we are looking at building our product strategy. So ease of use and ease of understanding comes first.
Thank you, sir, for patiently answering all the questions, and also thank you for the dividends flowing in. I think that's a good step. Thank you.
Thank you.
Thank you. The next question is from the line of Anshuman Dev from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity, sir. So my question was regarding this less than 2-year-old client portfolio that you have. Because it's less than 2 years old, so what gives us confidence in this customer profiling? Because we are less than 2 years, right? So you may have seen the amount of cycles that you have seen with them is lower. So what gives you confidence about this customer base, and how much of them are new to the market? If you could give some color on this particular segment. That's the only question. Thank you.
Yeah. See, one thing is that we map our old customer and new customer in terms of their behavior in first year and second year, and we track that deviations. So what we are seeing, there are positive deviations in customer who have been acquired digitally and who are trading digitally. So that gives us our confidence that if track record of 1-2 year was better than that old customer, so going forward it would be better. One, because this new set of customers are trading through app. And we have seen in the market, like if a customer is not trading for 2-3 months, in a physical market, he used to lose customers, dealers contact, or dealers to attract. In app world, app is always there. There's no attrition. So whenever this customer wants to come back, he has to just start trading or investing back through this app. So that's the reason we believe that lifetime value of this customer would be higher than that old customer. Tracking every quarter's activity with that old customer. That is where we feel that this model is going to work better. What was the second question? I just missed that. Sorry.
Yeah, my second question is how much of them are new to markets, and if you could also say what is the wealth base of this customer? Are they very in the sense are they speculative, or they are very in terms of also capable in terms of they have considerable amount of pocket?
Right. Almost more than 70% people who are coming on our app are new to the market. So we are able to build kind of educational programs for them so that they are able to understand this equity journey better. So we have seen, be it an old customer who came in physical world or a new customer, they start their activity exposed in equity by trading, by having high expectation. Then after 2-3 years they realize and they go towards kind of a mutual fund, investment, deliveries and all that. So I think journey in terms of this new youth and previous customer who used to come to the industry is same. What is different? This youth is very social media savvy. He is learning these tricks very fast. I know people from old economy, they should take years to understand options. Over here, youth, they are able to hear experts, they are able to use algo formulas and are able to hedge their risk better than people who did not know about these instruments. So what I am seeing that these are the youth who are getting into their first salary or earning from their business, and they are straight away starting journey with equity. One, because equity is giving better return than risk-free assets compared to previous generation who used to get 10%, and equity returns were expected to be around 11-12% at that time. Today, when we are expecting corporate earning to grow at 14-15%, and risk-free assets are giving less return. So definitely when this youth is starting his journey from his initial paying days, these are the one who would be wealth bearers in next 15 to 20 years. So being into a fintech world, we have to get this youth early in their stage to use our app. If you believe that our economy is going to grow at a nominal rate of 12-13%, in next 20 years you will see GDP growing at by 15 to 16x. Majority of the wealth will be created by this youth. So we are not looking at what wealth base they have today. We are looking what wealth they would be having in next decade or so. So I think fintech world is all about serving this small ticket size and giving best of service, because in technology world there is no incremental expenses. There are one-time expenses, and once we achieve scale, we can serve any customer at any cost.
Got it, sir. Thank you so much. It's really helpful.
Thank you. The next question is from the line of Akshay Ashok from Dalal & Broacha Stock Broking. Please go ahead.
Hello. Yeah, okay. Congratulations on a good set of numbers. I have two questions. So the cash turnover market share has been dropping continuously. Is it only because of the peak margin norms, and will it revive in the coming quarters, because your cash turnover market share has now come to 13.8% from 16.3%. That dip has been quite high in this Q4 to Q1. Although in the previous quarters, the drop was very low. So this, will it normalize? And even in incremental market share demat account, there has been a slight dip to 16.6% from 17.6% in Q4. So will this change going forward, or is it a one-off? And then what is the, any initiative you are taking to make your clients more active? Like your client activation rate is 37%, is what I heard. But the competitors, although they have a lower client base, their activation rates are a bit higher at around 55-60%. So is there any way by which you are planning to increase your activation rate? Because now that all have onboarded, so rather than focusing on continuously increasing clients, will the strategy be to make the existing clients active? Yeah, that's it from me.
Okay. One cash market share which had dropped, and now it is progressively improving. Vinith, you have number on cash market share?
It is 13.8%.
No, in terms of progressively, I think if we share that number, I will just...
Yeah, sure.
And on your second question, let this data come. On this thing, active customer base, I think our ratio is better than industry. Industry is at around 33% and we are around 37%. Having said this, we are, as I said, that we are working on lots of journeys, how to make customer more engaged and make them more active. So as we are hiring more talent on artificial intelligence and machine learning, so that is where our data scientists would work on how to understand customers who have onboarded, who are on our app, what are the needs they have, and how to give them a solution to make them more active. So going forward, we are going to see a better activation ratio on our app. Having said that, currently we are better than industry. That is what data suggests. Let me just come to on that cash market share. Vinith, you have that?
Yeah. So the cash market share for the last 3 months, it's an average of about 14%. So we saw some impact because of the 1st June phase implementation, but that we've seen in the past as well. In the month in which the the phase comes into effect, we see a momentous decline, but then it gets back to normal.
Akshay, what we can see is that maybe after one or two quarters, when this peak margin is implemented completely, we will see this will bounce back, because there are lots of things we can just work out on making this customer active on delivery front. But yes, whenever there's one kind of installment of peak margin, there's a knee-jerk reaction.
Okay. Thank you.
Thank you. The next question is from the line of Vikas Mistry from Moonshot Ventures. Please go ahead.
Hello.
Yeah, we can hear you.
Sir, actually, I have two questions. Questions to Narayan sir, because as we have seen that making community is very important for the sustained flywheel effect to ensure the long-term LTV of the company. So what we are doing to ensure that we have a strong, better community of traders at the same time for investors, and how we are going to challenge the money control app, which you know, because it is whole community moving around that. Can you throw some light on it?
Narayan will answer, but before that, we are not competition to money control. In fact, we should allow communities to be formed anywhere where they like, where they think that topic, what they are interested is discussed. Because to form kind of a platform where we try to make community is, I would say, is not a right approach. Let it be with those organizations or those sites which have a kind of good population of talking on the topic. Having said, we are also building lots of community within our app. So, actually, this market has expanded because of this community being formed. As I said, that youth is far social media savvy. So he finds it very educational to go to some community, neutrally understand what they have to say. So we would not like to put a color that all community has to be formed under our app. Narayan, if you want to add on this.
Yeah, thank you, Dinesh. Actually, it is exactly what Dinesh just mentioned, right? Because we want to be an open and fair marketplace. And we believe that the key to creating that marketplace is to allow open access to our APIs so that innovators can come and build best-in-class products for a much larger audience than exists today. So the way we facilitate building that cohort, that set of cohorts, that set of community, is by encouraging people to build a platform and by increasing our awareness using social media initiatives on WhatsApp, on Facebook, on a whole bunch of different, on YouTube, by building more of these channels so that users get more and more data, so they can continue to get more and more data which is more relevant to their trading style. And that is really the strategy that I see us building on over the next couple of years. But I absolutely think that it's not we don't want to be in the business of especially money control or any of the things that you mentioned earlier, which is what Dinesh was mentioning.
Okay. Mike, actually, I want to understand that we have launched a product known as Smart Budge. So I try to correlate with it, whether it will have a community part and whether we will leverage that to make sure that persons who has become less interested, let's suppose for 2 or 3 months, that then he can just come and see what's happening in the stock market, and then we give a nudge to him to trade. So I'm extrapolating on the Smart Budge platform and all that. Can you?
Yeah. Because we would be providing lots of kind of relevant content. But as I said that, as Narayan also said, we would like to allow our APIs to be used by other platforms so that we are able to form a bigger community where content related to broking what has to be given to customer we will provide. But there are lots of general information which is available across a different platform. So to cover everything on one platform is not possible. We will give relevant content, but there are lots of content which are available across a different platform. So we would like to integrate all that content also within our app or within our digital properties.
Okay, one last question on Angel Spark. We have already started a journey on that. And my question is that whether we will start fine-tuning algos afterwards, after 6 months, or we already having data management platform of our older data. Should we start fine-tuning those data right now, when we will leverage that after 6 months, as soon as we launch the app?
Narayan, you would like to answer this?
Yeah, so that's a very good question. I mean, we have a rich history of our data, which has been used by millions of customers over the last several years. So I first want to say that our existing product is already best in class. If you look at our rating, if you look at people's feedback, it is one of the best products. If not, it's easily one of the top, within the top 2 or 3 products today in the space. Now, we want to leverage this data and provide a even better experience to our product, to our customers when we officially launch Spark, as Dinesh Bhai mentioned early on, in the next 2 or 3 quarters. So yes, we will be using that data, but also we will be continuing to learn from our new customers, because we are adding so many customers every single month that we are also continuing to learn about what the new customers want, what profiling works, what the preferences should be. And that is where I think you will see a lot of innovation in Spark over what you already see today in our existing app.
Okay. My last question is that we have added most of our clients within last 1 year or couple of years, but our activation rate is very low. It's not. We are not comparing with the industry because we are not competing with the industry. We are the leaders in the industry, so our activation rate should be better than leader. Leader is having activation rate of over 60%. We are having 37%. How we are going to bridge that gap?
See, everyone has a different kind of acquisition routes, and as I said, what we look at unit-wise economy for different sources. So if we just restrict ourselves from one source, we can get a better active customer. But what I am seeing is that from different sources, when customer is young or is not very active initially, but they become active at a later stage. So right now we are grabbing every land which is available where economically it makes sense for us to acquire and generate revenue and make it profitable within the year that we acquire. So our game plan is a bit different. It will vary from person to person, organization to organization. What we are looking at is that when we are acquiring customer from different sources, what is their activation ratio? More than that, what is the unit-wise economy we are achieving from that particular customer? So we are not averse to just attracting very active trader or a person who is low ticket size. We are open to everybody who wants to use our platform, but in that definitely activation ratio of an investor is different than a trader. So we are not, when we are optimizing our digital acquisition kind of engines, we are not optimizing just for an active trader. Even we want a customer who just invests 1 day or 2 days in a year, but we know his lifetime value would be much higher, so that person is not burning his capital. So we look at unit-wise economy. Based on that, we acquire our market share.
Thank you. Next question is from the line of Rajesh Vora from Jainmay Venture Advisors. Please go ahead.
Good morning, Dinesh Bhai. Congratulations to you and the team for a blockbuster results and a phenomenal client acquisition that you have done. My question is about last call you mentioned that going forward you continue to reinvest the incremental margins that you make due to this massive scale up and the concurrent cost in technology, and OPEX is not going to be in line with revenues, obviously, given the tech platform. So that's a very powerful model to go after. Not many companies have that luxury. Given that as maybe, and the fact that 2/3 of current client of 5.3 million, 3.5 million are acquired in this last 15 months, which is phenomenal. Can you weave in your thoughts about margins being reinvested, because you will have problem of plenty on margins given the way you have been growing. So can this growth engine continue the way? I mean, I'm not asking about next quarter or next 3 quarters. I'm looking at next 3 years, 5 years. Can we continue to grow at breathtaking speed and also maintain margins? And if that is the case, there is so much money to be reinvested because incremental costs are not that high. So I'm not looking for a number here, but more a color on complexion of the journey that will happen over the next 3-5 years.
Rajesh, very intelligent question, I would say, and a person who has tracked digital kind of organization for, I think this is a quite relevant question. That's the reason in my speech I told that we would be onboarding lots of experts on data scientist, our machine learning, having machine learning capabilities, because we want to invest in tech and tech-related people. Because going forward, we are looking at market which will be more evolved than what it is today. So we have to invest in future, but we have enough kind of margin, incremental revenue that we generate that has an increase, better margin than the previous client base. So continuously what we will be doing is that, because we have to upfront this cost, that the reason in my initial speech I told, for 2 or 3 quarters we have budgeted a good amount of expenditure which will go towards building this kind of talent pool with us. Not only talent pool, how to scale up our data centers and all that, so that we are ready for next 2-3 years. But good thing is that still after spending all this, we are confident that we'll be able to maintain our margins. That is because incremental business is giving lots of margin. If we don't invest today, we are not looking at future, we are just looking at present. So what we are looking at, we are trying to balance current quarters, plus we are trying to look at next 3-5 years.
Sure, that's very useful, Dinesh bhai. And the other side, I mean, we have been, as you rightly mentioned, and also Narayan, that, it's just the beginning in terms of your digital model just a couple of years ago. And that couple of years has been fantastic. Given the way this has been a dream run so far, it has probably beaten your own internal expectation also, I don't know. In this dream run, what can 1 or 2 things that keeps you busy and Narayan and the team? What is the biggest challenge? What are the biggest couple of risks that you foresee that can somewhat puncture this phenomenal dream run that you're going through?
See, I will ask Narayan to answer this later. First, let me tell you that we both are very excited
Line of Mr. Dinesh Thakur.
Sure.
Mr. Thakur, I'm not able to hear you. There's a lot of disturbance. We would request the participants to please stay connected as the line for Mr. Thakur got disconnected. Thank you for patiently waiting. We have Mr. Dinesh Thakur reconnected, so you can go ahead, please.
So what I was saying, that opportunity is quite huge. In India, if we have to serve this kind of millennials with a low ticket size, we have to work out lots of solutions. So what we are saying is a great future. There is nothing which can spoil this kind of party, because our youth population is just started earning. So we see a big opportunity, and fortunately for Angel, we are able to attract good talent. So we feel we'll be able to give solution to this youth. Narayan, if you want to add on this.
Yes. So as Dinesh mentioned, right, this market is it's a very, very early stage market. The market opportunity is at least 10x more than what it is today. So the thing that keeps me up is how should we think about ways to launch newer and better products and get them in the hands of these customers? How do we build better journeys, better experiences, so that the first time experience for anybody who is entering the space is very fulfilling? And for somebody who is a mature investor, they're able to get more and more insights and more value continuously from the market. So, it's a very exciting opportunity, but again, there is so much more with it. The realm of possibilities is so huge, especially with people from tier 3 and tier 4 cities now coming online, that we have to build a product for all of them. We cannot just be building for tier 1 and tier 2 cities, right? We have customers everywhere. And that's where the big opportunity is for Angel.
Wonderful. Thank you so much, Narayan and Dinesh Bhai. All the very best.
Thank you.
Thank you. Due to time constraints, that was the last question. I would now like to have the conference over to Mr. Dinesh Thakkar for closing comments.
I was unable to hear you.
Also, would you like to add any closing remarks?
Closing remarks. Okay, fine. We are done with question and answer?
Yes, sir.
Okay. So thank you everyone for joining us today on this earnings call. India's fintech industry is at the cusp of strong growth. Players who were able to identify this opportunity early and will lead this growth. In digital era, there is a space for only few players. It is imperative that we keep investing in augmenting our technology infrastructure, human talent, and product and service offering to become leaders in this segment. With a strong corporate structure in place, coupled with our superior product and service offering, I am confident that we are poised to achieve our goal of attaining the leadership position over in next couple of years, while keeping our profitability intact. There may be periods of interim ups and downs, but our nimbleness, expertise, and marketing initiatives will keep us ahead of the curve. I am certain Angel will play a dominant role in deepening the culture of systematic wealth creation across all segments and age groups in a long run. Our strategy to expand our product and service bouquet to include protection and sustained wealth creation product will play a vital role in this journey. With Narayan on board, I am sure you will witness a significant technological transformation in times to come. If you have any queries, please do reach out to our investor relations team or to SGA, our investor relations advisor. We wish you all a good day and a prosperous year ahead. Stay safe, stay strong. Thank you.
Thank you.